Hey everybody, Marty Missouri here, October 3rd, 2023, Tuesday after hours. Clients, this will come to you with a link in your email inbox in the morning. This will serve as Wednesday's morning message. Those of you who like the technical analysis, after I talk at everybody a little bit here about current setup, then we'll get into the detailed chart analyses. So market's been selling off. I'm sure most of you probably know that. And that's not inconsistent with what we've been showing on the charts here for a while, particularly of late. Thinking about the nature of the selling, at least my observation, is that actually it's not being catalyzed by what I think ultimately makes for even more serious downside risk. Ironically, it's being inspired by news and commentary from Fed officials that doesn't really comport with a recession, lower inflation, lower interest rate thesis, which is our next leg down bear market thesis. It actually is inspired by things like today's job opening and labor turnover report that actually came in very surprising. Now, I'm going to give you some of that detail and tell you why the market sold off on that, and then talk about yesterday what supported at least a sector or two of the market, which was something that suggests that the economy is going to be weaker. But first, today's JOLTS report, which came in with a reading of 9.61 million job openings, and that's up from 8.9 million in July. And keep in mind, this is a month behind, so this is August number that came out. And so that was a surprise because job openings have been steadily coming down. The quits rate, which is very important, that stayed the same, and that's relatively low. That goes up when the economy is good and people quit one job for a better one. When that's down, that suggests some uncertainty that people are holding on to their jobs. And you know, it's a funky report because apparently multiple listings for one job will show up across states, and that ends up not getting filtered. So it's still a big number, and it still says something robust about the economy. And it's not entirely inconsistent with all of what's said on the business surveys. They're still saying they have a tough time finding good people, which suggests that they're still looking for people, or I should say qualified people, for the job openings. So that news came out, and that really sent yields higher, sent stocks lower. At least there sure seemed to be something coincident there when we looked at the timing of it. Now, yesterday the market was selling off, and the S&P came close to, I think even barely to the positive, the S&P 500 cap weighted or headline index, and the NASDAQ 100 index was up like 0.75% yesterday. Now, to give you a feel for what the market actually did yesterday, the S&P equal weight index, which is really the broad market because it just gives every component or every member equal measure in the index, it was down 1.11% yesterday. So it had a big down day. Now, the news that seemed to spark a comeback in at least really the tech sector, let's say, was a report from the Dallas Fed relative to banking conditions. Okay, so from that report, loan demand has been declining for a year, and the pace accelerated this period. Overall, loan volumes declined at a quicker pace this period as well. Loan non-performance rose with increased delinquency across the board, particularly the consumer loans. Credit standards continued to tighten, most notably on the commercial side. Loan pricing pushed up further, though at a slower pace. Bankers remain pessimistic, with expectations for increasing loan non-performance, decreasing loan demands, and worsening business activity over the next 6 months. Now that completely comports with our thesis about a weakening economy. Tighter lending standards exacerbate that. And so what did that do? Well, that got the market thinking that interest rates will maybe come down, that the Fed will get softer and so forth. Now, what I've been saying last few commentaries is that in the near term, I actually expect the market to rally as the data get weak, because that'll be consistent with the trading that bad news is good news and the Fed's going to get soft on weak data. But as I showed you a week or two ago, 60 years of history, that if we have a recession, even though the Fed's cutting, a lot of downside risk to stocks. So interesting dynamics, a lot of push and pull in this market right now. If what I just said is on balance the right narrative, short term and longer term, well, then we should look for some relief, and that would come on weak jobs data on Friday. And I say relief in the equity market and relief in the yields market, meaning bonds would rally and yields would come down a bit. Now, one parting comment to those of you who are going to leave here after my narrative, with regard to interest rates and with bonds, right now the consensus seems to be that yields are going even higher, largely because with lots of deficit spending to come, there's going to be lots of treasury bond issuance. And the question is going to be, is there going to be a big appetite to purchase those treasury bonds internationally and domestically? And to the extent that the answer is no, to the extent that supply outweighs demand, well, then the price of that debt's going to go up, and that's yields, that's interest rates. That's bearish for bonds, bearish for stocks. Now, my view is that we're getting real close to the end, that the Fed is likely done. I'll be surprised if there's another rate hike, quite frankly, and because we have a negative view over economic conditions going forward. And I think as that view gets expressed, and as what I just shared with you about tightening lending standards and so forth really shows up in the economy, then suddenly Fed funds futures are going to discount more aggressive rate cuts next year, and so on. And ultimately, that's the scenario under which we see something more ugly to the downside, potentially, in the equity market. But right now, though, there's a lot of bullishness over interest rates, which would be bearishness over bond prices. And my whole point is I think a lot of that has been priced in. And I think that those who are bearish on bonds, price-wise, bullish on interest rates, could get trapped a little bit here. So there's the narrative. Those of you who don't want to go through the technical analysis, thank you so much for listening this far, and I hope you have a great rest of the day. As for those of you who want to stick around, take a look at the chart on your screen. That is the S&P 500 daily chart. Recall that I had drawn a bear flag pattern here that I said made a lot of sense to break down, and I drew it before we actually had the breakdown. Now it's, so far it's official. You take the flagpole, and that's going to take us down to about 4,000. Now, having said that, I also said that I see really strong support potentially right here at the 200-day moving average / 4,200. Virtually got there today, bounced off of it, just kind of flat in the after hours looking at the futures. So if that's correct, pretty good bounce perhaps to come here over the next few days, week or three, right? Make no mistake, folks, there's got to be a serious army of stop losses under that 200-day moving average. Ultimately, if we break through that, those get triggered, and then there's that whole option structure that I talk about. When the setup is as it is, dealers are having to short the underlying security that they're selling options on to hedge their own downside exposure, and that's been happening here, and that can exacerbate things to the downside as well. So really key area right in here, going to be very interesting to see if we break that with momentum. Then that that 4,000 comes, I think, pretty swiftly. I mean, you could argue, for some support right in here as well. And of course, it won't be a straight line. I've been doing this a long time, and I've seen this sort of thing play out. Ultimately, in a recession scenario, stocks are overvalued right here, and they've got a ways down yet to go. But we'll see. We're open to all possibilities right now. Near term, wouldn't surprise me to see a bounce, but how much of one and how long it lasts, if at all, if we see one at all, that of course remains to be seen. Jumping over to the NASDAQ 100 ETF that we track a lot, bear flag there as well, broke down below. Haven't filled this gap that I talked about, tried to, came back. Did bounce off of 350. Remember, folks, a while back, I said once we break through here, I don't see much below there and 350, kind of a big air pocket. Remember that volume analysis kind of pointed to that as well. Bounced right off of that here a few days ago. We'll see. Ways still to go up to the 200-day moving average. No bullish divergences on the daily chart that I can point to. This actually confirms that this is bearish. Yeah, you might argue for one there on the RSI, but we'll see. In my morning report, I said at the time that we had 6 positive sectors and 5 that were actually notably negative on the year. Well, now we have 6 negative on the year and a couple more threatening to get there, just barely positive, and just 3 left that are still positive on the year. And again, this is where those magnificent 7, those top positions in the S&P and the NASDAQ, that basically are holding those indexes up. Without those, you're here or probably negative at this point. So breadth is resoundingly bearish. And speaking of breadth, there are only 12 stocks, call it 13 stocks in the S&P trading above their 50-day moving average. And you notice we've tracked this a long time. I'll point to these bullish divergences. You could call that one as well, where the stocks are going down, but the breadth starts getting better. We just don't have that at this point. I mean, this suggests that this could get worse before it gets better, pushing right on that trend line right now. With regard to the 200-day moving average, S&P is still above it, but only 39%, so 61, call it 40%, so 60% are trading below their 200-day moving averages. And again, from here, from here to here, you have lower stocks, and you do not have a bullish divergence just yet. You got one back in here from this point, right, which was down. You had bullish divergence that you could point to here, but we just don't have that here. So while I would not be surprised by a notable bounce, you just don't have huge technical support, at least in terms of breadth for it. This one I keep throwing because this one's been bugging me for a long time. This looks very much like the bearish divergence in the NASDAQ advanced decline line, advancing issues versus declining. While the stock market was hitting all-time highs, or the NASDAQ itself was, this was rolling over. While the NASDAQ was rallying hard, this was rolling over even worse, and now we're breaking down. A real reliable indicator for us for a long time. And then on yields, I suggested last time that it looked to me like this was breaking down and that we would, threaten the bottom of this wedge. Well, that was wrong, right? That has gone higher. This is still here, but we broke out above that, but we still have what is at least a channel. Yeah, we still clearly, I'll clean those lines up, but yeah, that's still your rising wedge. But you don't have bearish divergences. You're extremely overbought here on interest rates. And you'd think there's got to be some relief there, but you don't have those technical bearish divergences here. So that suggests that, we could get some consolidation and much higher. That's what the interest rate bulls think, or bond bears. I think that's a stretch. I think we're getting close to seeing a peak. We could get 5%. I know some characters think it's going to go as high as 7%. We'll see. I'll definitely admit that I was wrong, but I'll be surprised. And then the inverse of that would be the price. This is TLT, the long-term Treasury ETF. This one we actually added a little bit to. We still don't have what I would call a full position in the kind of environment we expect to be in. It is as oversold as it was all the way back in here in late 2022. And you can see ultimately we had a pretty good rally off of that level. We shall see, and that would be yields coming down. So we'll see. And then last but not least, the dollar. There's still reason to be bullish. That would be the interest rate narrative as much as anything else. We do have a bearish divergence on a very overbought RSI. If interest rates roll over, probably going to see some relief in the dollar. It's going to look very good for emerging markets and other Asian stocks that have been beaten to smithereens here the last week or so. Commodities have taken a pretty good hit. That would be very bullish for commodities. So if interest rates begin to roll over, some of these things that we have some exposure to in our core are going to come back to life in a hurry. But again, all that remains to be seen. Folks, I will leave it there. Thank you, as always, for watching and listening, and be back with a video at the end of the week, and of course Thursday with another written commentary first thing in the morning. Take care. Bye-bye.